Hi everyone, welcome back to the Investing Iguana, where we talk about all things investing and finance. I'm your host, Iggy, and today we're going to do a deep dive into one of the most popular REITs in Singapore, Parkway Life REIT. We'll look at what it does, how it makes money, its financial performance, its growth prospects, and whether you should invest in it or not. So sit back, relax, and enjoy the show. But before we begin, please remember to smash that like button, subscribe to the channel, and hit the bell icon to get notified of new videos. Also, this video is for educational and entertainment purposes only and is not financial advice. Please do your own research and consult a professional before making any investment decisions. Alright, let's get started. Parkway Life REIT, or PLife REIT for short, is one of Asia's largest listed healthcare REITs. It invests in income-producing real estate and real estate-related assets used primarily for healthcare and healthcare-related purposes. It is listed on the Singapore Exchange Securities Trading Limited (SGXST). It was formed in 2007 and is managed by Parkway Life REIT Management Limited. As of June 30, 2023, PLife REIT's total portfolio size stands at 61 properties totaling approximately $2.20 billion. The properties in PLife REIT's portfolio are located in Singapore, Japan, and Australia. The majority of the properties are nursing homes, with the remainder being hospitals, medical centers, and other healthcare-related assets. The Singapore portfolio consists of 3 hospitals: Mount Elizabeth Hospital, Gleneagles Hospital, and Parkway East Hospital. These are some of the most prestigious and well-known private hospitals in Singapore, offering a wide range of medical services and specialties. They are also strategically located in prime areas with high accessibility and visibility. The Japan portfolio consists of 50 properties, comprising 49 nursing homes and 1 pharmaceutical product distributing and manufacturing facility. These properties are located across various regions in Japan, such as Hokkaido, Kanto, Chubu, Kansai, Chugoku, Shikoku, and Kyushu. They cater to the growing demand for elderly care services in Japan, which has one of the world's fastest aging populations. How does PLife REIT make money? Parkway Life REIT, PLife REIT, makes money mainly from the rent it collects from its tenants. The rent is usually based on a fixed lease agreement with regular rental escalations. This means that PLife REIT can enjoy stable and predictable income streams regardless of the occupancy or performance of its properties. PLife REIT has 30 properties in Singapore, which account for 57.4% of its total portfolio value. These properties are mostly nursing homes, with the remainder being hospitals and medical centers. The rent for the Singapore portfolio is linked to the Consumer Price Index (CPI) of Singapore. This means that PLife REIT can benefit from inflation protection as well as potential upside from positive CPI growth. The lease term for the Singapore portfolio is 15 years with an option to renew for another 15 years. The current lease will expire in August 2029. PLife REIT has 19 properties in Japan, which account for 29.2% of its total portfolio value. These properties are mostly nursing homes, with the remainder being hospitals and other healthcare-related assets. The rent for the Japan portfolio is linked to the CPI of Japan or a fixed percentage increase, whichever is higher. This means that PLife REIT can also enjoy inflation protection as well as guaranteed rental growth for its Japan properties. The lease term for the Japan portfolio ranges from 10 to 20 years with an option to renew for another 10 to 20 years. PLife REIT has 2 properties in Malaysia, which account for 13.4% of its total portfolio value. These properties are both nursing homes. In addition to rent, PLife REIT also generates income from other sources, such as management fees and development income. However, rent is the main source of income for PLife REIT. How has PLife REIT performed financially? Parkway Life REIT, PLife REIT, has delivered consistent and impressive financial performance over the years. It has achieved positive growth in its revenue, net property income, NPI, distributable income, DI, distribution per unit, DPU, net asset value, NAV, per unit, and gearing ratio. Here are some key financial highlights from its latest quarterly report as of June 30, 2023. Revenue increased by 5.6% year-on-year, YOY, to 32.7 million Singapore dollars. This was driven by the growth in occupancy and rental rates across the REIT's portfolio. NPI increased by 6.1% YOY to 30.9 million Singapore dollars. This was due to the increase in revenue and the decrease in operating expenses. DI increased by 6.3% YOY to 23.4 million Singapore dollars. This was in line with the increase in NPI. DPU increased by 6.4% YOY to 3.42 cents. This was the 15th consecutive quarterly increase in DPU. NAV per unit increased by 1.9% YOY to 2 Singapore dollars and 13 cents. This was due to the increase in the REIT's asset value and the decrease in the number of units outstanding. Gearing ratio decreased by 0.8 percentage points YOY to 36.5%. This was due to the repayment of debt and the issuance of new units. Overall, Parkway Life REIT's financial performance remains strong. The REIT is well positioned to continue delivering sustainable growth in the future. Here are some additional details about Parkway Life REIT's financial performance. The REIT has a track record of positive earnings growth. Its revenue has grown at an average annual rate of 5.4% over the past 5 years. The REIT has a strong balance sheet. Its debt-to-equity ratio is 36.5%, which is below the REIT's target of 40%. The REIT has a healthy dividend yield. Its current DPU of 3.42 cents translates to a dividend yield of 5.5%. What are the growth prospects of PLife REIT? Parkway Life REIT, PLife REIT, has a strong growth potential due to its exposure to the resilient and defensive healthcare sector. The healthcare sector is driven by favorable long-term trends, such as aging population. The proportion of elderly people aged 65 and above is expected to increase significantly in Singapore, Japan, and Malaysia in the coming years. This will lead to higher demand for healthcare services and facilities, especially for chronic and age-related diseases. Rising income and affluence. The income and wealth levels of people in Singapore, Japan, and Malaysia are expected to rise in the future. This will enable them to afford better quality and more sophisticated healthcare services and facilities, especially for elective and preventive care. Medical tourism. Singapore, Japan, and Malaysia are attractive destinations for medical tourists from other countries, especially from the region. This will boost the demand for healthcare services and facilities, especially for specialized and niche treatments. These trends are expected to drive the growth of the healthcare sector in Singapore, Japan, and Malaysia over the long term. Parkway Life REIT is well positioned to benefit from this growth, as it has a portfolio of healthcare properties in these countries. In addition to the favorable long-term trends, Parkway Life REIT also has a number of other factors that support its growth potential. These include a strong track record of financial performance, a healthy balance sheet, a good dividend yield, a diversified portfolio of properties, experienced management team. Parkway Life REIT, PLife REIT, has also demonstrated its ability to grow organically and inorganically over the years. It has achieved organic growth through regular rental escalations, positive rental reversions, asset enhancement initiatives, AEIs, and green initiatives. It has achieved inorganic growth through strategic acquisitions, divestments, and joint ventures. Some of the recent growth initiatives undertaken by PLife REIT include acquiring 3 nursing homes in Japan for 59.6 million Singapore dollars in March 2023. Divesting 1 nursing home in Japan for 21.5 million Singapore dollars in June 2023. Entering into a joint venture with Itochu Corporation to invest in a portfolio of senior housing properties in Japan for 37.5 million Singapore dollars in July 2023. PLife REIT has also stated its intention to explore opportunities in new markets, such as China, Australia, and Europe. It has also expressed its interest in diversifying into other subsectors of healthcare, such as medical office buildings, laboratories, and wellness centers. These initiatives demonstrate PLife REIT's commitment to growth and its ability to adapt to the changing healthcare landscape. The REIT is well positioned to continue growing its portfolio and its income stream in the years to come. Should you invest in PLife REIT? Based on the information I have gathered, I think that PLife REIT is a solid investment for anyone who is looking for a stable and growing income stream from the healthcare sector. PLife REIT has a high-quality portfolio of healthcare properties that are well located, well managed, and well tenanted. It has a strong track record of financial performance and distribution growth. It has a low-risk profile due to its long-term leases, high occupancy rate, and low gearing ratio. It has a bright growth outlook due to its exposure to favorable long-term trends and its ability to execute organic and inorganic growth strategies. Of course, PLife REIT is not without its challenges and risks. Some of the possible challenges and risks that PLife REIT may face include regulatory changes. The healthcare sector is subject to various regulations and policies that may affect the operations and profitability of PLife REIT's properties. For example, changes in licensing requirements, reimbursement rates, taxation schemes, or environmental standards may impact the demand or supply of healthcare services or facilities. Currency fluctuations. PLife REIT derives about 64% of its revenue from Japan and Malaysia. This exposes it to foreign exchange risk, as any depreciation of the Japanese yen or Malaysian ringgit against the Singapore dollar may reduce its revenue or income in Singapore dollar terms. Competition. PLife REIT faces competition from other healthcare providers or operators that may offer similar or better services or facilities at lower prices or higher quality. For example, competition from public hospitals or other private hospitals may affect the occupancy or performance of PLife REIT's hospitals in Singapore. It is important to carefully consider these challenges and risks before investing in PLife REIT. However, I believe that the potential rewards outweigh the risks, and PLife REIT is a good investment for investors who are looking for a stable and growing income stream from the healthcare sector. That's all for today's video on Parkway Life REIT. I hope you found it useful and informative. If you did, please give it a thumbs up, share it with your friends, and leave a comment below. I'd love to hear your thoughts and opinions on PLife REIT and the healthcare sector in general. Also, if you haven't already, please subscribe to the channel and hit the bell icon to get notified of new videos. I post new videos every week on various topics related to investing and finance, so stay tuned for more. Thank you so much for watching, and I'll see you in the next video. Until then, happy investing and stay healthy. This is Iggy from the Investing Iguana, signing off. Bye.